Hi guys. Welcome to my YouTube channel. So before we get started, make sure to hit the like button, also subscribe to my channel. In this video, we will talk about, can you earn money in stocks? So make sure to watch the full video. The New York Stock Exchange, NYSE, was created on May 17, 1792, when 24 stockbrokers and merchants signed an agreement under a buttonwood tree at 68 Wall Street. Countless fortunes have been made and lost since that time, while shareholders fueled an industrial age that's now spawned a landscape of too big to fail corporations. Insiders and executives have profited handsomely during this mega boom, but how have smaller shareholders fared, buffeted by the twin engines of greed and fear? The basics of stocks. Stocks make up an important part of any investor's portfolio. These are shares in a publicly traded company that are listed on a stock exchange. The percentage of stocks you hold, what kind of industries in which you invest, and how long you hold them depend on your age, risk tolerance, and your overall investment goals. Discount brokers, advisors, and other financial professionals can pull up statistics showing stocks have generated outstanding returns for decades. However, holding the wrong stocks can just as easily destroy fortunes and deny shareholders more lucrative profit-making opportunities. In addition, those bullet points won't stop the pain in your gut during the next bear market, when the Dow Jones Industrial Average, could drop more than 50%, as it did between October 2007 and March 2009. The Employee Benefit Research Institute. The Employee Benefit Research Institute, EBRI, studied the crash in 2009, estimating it could take up to 5 years for 401k accounts to recover those losses at an average 5% annual return. That's little solace when years of accumulated wealth and home equity are lost just before retirement, exposing shareholders to the worst possible time in their lives. That troubling period highlights the impact of temperament and demographics on stock performance, with greed inducing market participants to buy equities at unsustainably high prices while fear tricks them into selling at huge discounts. This emotional pendulum also fosters profit-robbing mismatches between temperament and ownership style, exemplified by an uninformed crowd speculating and playing the trading game because it looks like the easiest path to fabulous returns. Making money in stocks, the buy and hold strategy. The buy and hold investment strategy became popular in the 1990s, underpinned by the four horsemen of tech, a quartet of huge technology stocks: Microsoft, MSFT, Intel Corporation, INTC, Cisco Systems, CSCO, and the now private Dell Computer, fueling the rise in the internet sector and driving the Nasdaq to unprecedented heights. They seemed like such sure things that financial advisors recommended them to clients as companies to buy and hold for life. Unfortunately, many folks following their advice bought late in the bull market cycle, so when the dot-com bubble burst, the prices of these inflated equities collapsed too. Despite such setbacks, the buy and hold strategy bears fruit with less volatile stocks, rewarding investors with impressive annual returns. It remains recommended for individual investors who have the time to let their portfolios grow, as historically the stock market has appreciated over the long term. The Raymond James & Associates Study. In 2011, Raymond James & Associates published a study of the long-term performance of different assets, examining the 84-year period between 1926 and 2010. During that time, small-cap stocks booked an average 12.1% annual return, while large-cap stocks lagged modestly with a 9.9% return. Both asset classes outperformed government bonds, treasury bills, T-bills, and inflation, offering highly advantageous investments for a lifetime of wealth building. Equities had a particularly strong performance between 1980 and 2010, posting 11.4% annual returns. But the Real Estate Investment Trust, REIT, equity subclass beat the broader category, posting 12.3% returns, with the baby boomer-fueled real estate bubble contributing to that group's impressive performance. This temporal leadership highlights the need for careful stock picking within a buy and hold matrix, either through well-honed skills or a trusted third-party advisor. Large stocks underperformed between 2001 and 2010, posting a meager 1.4% return, while small stocks retained their lead with a 9.6% return. The results reinforce the urgency of internal asset class diversification, requiring a mix of capitalization and sector exposure. Government bonds also surged during this period, but the massive flight to safety during the 2008 economic collapse likely skewed those numbers. The James study identifies other common errors with equity portfolio diversification, noting that risk rises geometrically when one fails to spread exposure across capitalization levels. Growth versus value polarity, and major benchmarks, including the Standard & Poor's S&P 500 index. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.